So now that we have our cash flows from assets estimated, what remains for us is to evaluate the project using one of the decision rules that we learned in the previous chapter. Right? These are my cash flows. You can see my negative investment, my years of positive cash flows. Again, I'm going to use my decision rules, and I'm going to say, do the cash flows justify the investment? And of course, the golden rule is the net present value rule. So we'll say, do the present values of the future cash flows equal or exceed the cost of the project, or the internal rate of return rule? And so we can look at that. We can plug it into our calculator, into Excel. We can calculate our net present value. Let's use a discount rate of 20% and check, and you should do this on your own, check, make sure that you get a net present value here of $10,648. And that's exactly how we combine these two things, right? And if we compute an IRR, we get 25.76. And so based on these two rules, do we accept or reject the project? Well, again, think back to chapter 9. The net present value rule says take any project with a positive net present value, greater than 0. So here, NPV definitely greater than 0, 10,648. We want to take this investment. The IRR is 25.76%. The internal rate of return rule says accept any project where the internal rate of return is greater than the required rate of return. And again, that's 25.76 is greater than 20. So we take the project based on both of these. Now that's just the rule. Remember, these rules they're very cut and dry. There's not any room for nuance in the rule. But in practice, we have to think about nuance. And one is like, with a net present value of $10,000, am I going to give up 3 years of my life working night and day, building a restaurant, running a restaurant, to only come away with $10,000 above my required return? I mean, in a practical sense, we have to be conscious of the fact that even if an investment investment is justified by the rule, in a practical sense, it may not be justified by life, and this may not be a project that we want to undertake. But if this is just a project for an existing firm, totally separate from all the discussion we had, then we take it, because $10,000 is worth the investment if we're a firm that's already doing all kinds of other things, and this is just an additional project that the firm is considering. Okay, so one of the things that we didn't use in that example, but that we should consider, and I brought up, is that there may be some salvage value available from the fixed assets that you bought, right? In other words, there may be some value left, and if I finish my project, like my restaurant, and I'm able to sell my tables and chairs and all my kitchen equipment, then I can recover some of the value inherent in those assets, and what that's called is salvage value. I can salvage those assets for whatever value is left. It's definitely not going to be what I paid for it, right? Used kitchen equipment can't go for what it costs originally, but there's going to be some value, and hopefully I can recover some of it. Now, how that affects our project is that this would be a cash flow that comes in the net capital spending. This would be a negative cash flow because I would be selling these assets, so it would be negative investment, negative spending, because I'm selling them. That's money coming back to me. Right? And so what I have to be aware of here particularly is that there may be a difference between what I sell it for and what the book value of those assets is going to be. And book value is my initial cost minus my depreciation in every year. So I'm going to look at, and if we think back to the example we just worked, at the end of the 3-year period, all of those assets were listed on the books as 0. But if I'm able to sell them for, say, $5,000, then I have depreciated those assets too far. The IRS considers me to have depreciated them past the true value of the asset. And if we flip back to our income statement, you can see that depreciation comes out before taxes. Depreciation reduces my EBIT, and because my EBIT is lower, the taxes that I pay are lower. And if the IRS thinks that I have depreciated too much, then I have paid too little in taxes. I've reduced my taxes by too much. And so that means that when I sell the asset and prove that my book value is different from the salvage value, I may have to pay some additional taxes on that sale. And so what we need to consider as a cash flow at the end of the project's life if we sell assets is what's called the after-tax salvage value. And right now we'll work an example and we'll talk about salvage value, and we're going to talk about depreciation in the following example. And again, the solutions are here in the slides for the example, as they always are. And so we talked about straight line depreciation, which is even depreciation in every year. But there's another kind of depreciation that we need to talk about as well. Straight line depreciation is the type of depreciation that is suggested or required by GAAP rules. And remember that GAAP is the generalized accepted accounting principles. And these are the accounting principles, the guidelines that public corporations in the US must follow when they file their accounting statements, their 10Ks, their income statements, balance sheets for the year. Now, the IRS will allow a different kind of depreciation called MACRS, where MACRS stands for the Modified Accelerated Cost Recovery System. And this is a type of accelerated depreciation. That's why it's called the Modified Accelerated Cost Recovery System. And you accelerate the depreciation from the later years into the earlier years so that you depreciate more in the early years, and that reduces your taxes early on. Now, companies like this because it allows them to reduce taxes now rather than later. And remember the fundamental rule of finance here, the present, the time value of money. There is value in delaying your tax payments because you'd rather have the money now rather than later. And so the Modified Accelerated Cost Recovery System allows companies to do that, and it's allowed by the IRS. So the MACRS is a series of 3 schedules, a 3-year depreciation schedule, a 5-year depreciation schedule, and a 7-year depreciation schedule. And the schedules are defined for different assets, so you would find your asset and then you would go look it up on the MACRS class schedule, and you would see which class it fell into. So for instance, computer equipment falls into the 3-year schedule, heavy machinery falls into the 7-year schedule. And that tells you exactly how to depreciate your assets. You can see over here on the left, on the second column from the left is the MACRS percentage column. This is the percent of depreciation in every year for your asset. So whereas a straight line 3-year depreciation would be 33.33% in all 3 years because it's even, so it's 1/3, 1/3, 1/3. MACRS is 33.33% in the first year, 44.45% in the second year, 14.81% in the third year, and then 7.41% in the fourth year. And you can see that there's 4 years here, even though this is called a 3-year schedule, because it allows us to have off calendar years. And that's not really important for this class. And you will never have to memorize the MACRS schedules. If you need them, I will provide them for you. So what we're looking at here is how do we affect MACRS depreciation? And the way we do it is we multiply the cost basis of the asset times the MACRS percentage amount in that year. So if we jump back to the example on depreciation we just worked, the cost basis of that asset was $110,000. So what we do is in every single year, and you can see in that depreciation column, we multiply 110,000 times the depreciation percentage in each year. So 110,000 times 33.33%. In the first year, we would depreciate our assets by $36,663. In the second year, 110 times 44.45%. In the second year, we depreciate by $48,895, and so on. Now, the important thing is that unlike with straight line depreciation, MACRS depreciation always fully depreciates the asset. So it always depreciates all the way to 0. So it completely depreciates the asset to 0. And that means with MACRS, we're very, very often going to have some difference between the final book value and any salvage value of the assets, because by definition, we're not depreciating to an expected salvage value, we're depreciating to 0. And you can see an example of the 7-year MACRS schedule here. Again, the MACRS percentages on the 7 years are different because we're depreciating 100%. So 7 years of depreciation means the percentages in each year are different, but the procedure is exactly the same. Multiply the cost basis times the percent depreciation in every year. And again, remember, if you need this on the homework or on the Excel or on an exam, I will absolutely provide the MACRS percentages. There's no need to worry about remembering them. If you need the MACRS percentages, you'll be given the MACRS percentages. Okay, so let's work a big problem here. In fact, we're going to finish this lecture by working 2 big problems. Here's the setup for the problem, and you'll see it. Here's the solution for the problem, and we'll work it out again. Here's the setup for a second problem, and the solution for a second problem will be in the examples. There's a third problem in here that we're not going to work. I would encourage you to work it on your own, and if you want to talk about it with me, or if you want to see the solution, you can send it to me. It's kind of the same as the second problem that we're working here. And the solution is here too, so if there's some misunderstanding with the solution, then please just send me an email. Ignore this an equivalent annual cost problem. That's not something we're going to cover in this class. I used to cover it. I don't cover it anymore, so please ignore this. And the problem is still here in case I ever change my mind again and go back to it, but please ignore it. And then that's it. That's all I've got. So that's the end of chapter 10. This is a big chapter. There's a big complex problems. The ones that you'll see on the exam are going to be simpler, so look at the review. There's 2 types of these, there's 2 examples of these problems in the review. They're much simpler. The cash flows are easier. That's the kind of problem to expect on the exam. Remember that there isn't any homework for chapter 10 because you have the Excel project, and I'm going to post an example here of the Excel project where I walk through a separate project in Excel so you can see what it looks like. I hope you guys are staying safe, and we'll see you next week.